Good morning, Wall Street. In this video, we're going to suggest to you not everything is all that bad in the stock market these days. Now, it is true that almost all stocks are in downtrends, or at best rallies and downtrends, but not all downtrends are the same. It's certainly fair to say that we have a lot of stocks that are in very sharp declines. But there are stocks that, while technically in a decline phase, the declines look more like this on a relative basis. So the idea becomes, if you're going to be involved in a diverse basket of stocks, to try to focus in on those stocks that have a downtrend that looks more like this than the plummeting patterns that we see here. It's not an easy thing to do, but we're going to show you how we try to get at stocks that are exhibiting this kind of relative strength. First, one of the things that are very important to us is how are stocks doing on a sector basis. And this is something that we've addressed in prior videos. And just to show you how that looks, this is a screen that we did, data as of February 27th. We've ranked the 24 sectors that we look at according to our power rank. And the power rank is a combination of our tech rank and our short intensity rank. And our tech rank is a measure of relative strength. So here we see that there are really 5 sectors that are exhibiting positive characteristics. And those are retailing, technology, semiconductors and software, food and beverage tobacco, and telecommunications services. Now, retailing, clearly the discounters are doing well in this market. So let's just call that Walmart and BJ's. The thing that really fascinated us was the relative strength in the technology stocks, specifically semiconductors and software. Computers, not so much. And the thing to note here is that in our tech rank, we're seeing outlier status of relative strength in these 5 groups. That's why they're colored green here. Our tech rank of 67 is fairly robust. 100 is the highest. But after telecommunication services, it's a fairly substantial drop-off to below 60 with the next industry group. And, of course, you have the real estate and transportation, banks, etc., financials. All of those are clearly underperforming the market. So where do we want to focus in on the long side, or what we want to buy? And that would be in these stocks here. And what would we want to short or clearly avoid? These stocks here. And it's interesting to note that transportation is doing particularly poorly here. Now, at the beginning of each week, we publish our short squeeze screens and our long squeeze screens. And looking at the short squeeze screens, we can see that we have not a long list. We're actually looking at 5 stocks here. 3 of them are semiconductors and 2 of them are software. So we've really focused in on the stocks for our screens for this week, a strong reflection of what's going on with the industry groups. And the long squeeze screens, these are stocks that also reflect the weakness in industry groups. We have railroad stocks and trucking stocks. And the characteristic of these stocks are that they have poor relative strength. As you can see, this is primarily our worst ranking on a technical rank basis. Very little short intensity. So there aren't enough people shorting these stocks. There's not enough negative sentiment. And in fact, the only stock that we have contrary to the industry group breakdown was Adobe Systems. And as it turned out, this stock this week has been the one that hasn't really gone down all that much. It's actually done relatively well. So that just highlights the power of the industry group activity being an influence on a stock's price action. So now let's look at those stocks in each one of these screens as they moved with yesterday's price action. Now yesterday the S&P fell 4.25%. The short squeeze screen, you can see that all of these stocks fell yesterday. And in fact, in the long squeeze screen, most of the stocks fell, but two of them rose. The Adobe, which was from a stronger industry group, showed relative strength yesterday. So that didn't move the way we had expected with the other stocks in this screen. The idea is we're essentially creating baskets of stocks where we expect the short squeeze screen to outperform and the long squeeze screens to underperform. Yesterday, the short squeeze screens fell on average 2.54%. And the long squeeze screens fell 6.11%. So the difference between these two screens was a positive 3.57%. And so relative to the loss in the market yesterday, the net of these screens outperformed the market by 7.82%. That's not bad from picking these stocks at the beginning of this week. And in fact, for the week, the short squeeze screen dropped 2.58% so far, and the long squeeze screen dropped 10.13%. So the point here is that even when the markets are swirling the drain, there are strategies that over time can help you weather the storm. Hope that helps. See you next time.